In many financial conversations today, cash is often treated as a weak asset. You hear statements like, cash is trash, your money should always be invested. Keeping money in cash means you're losing to inflation. These ideas contain partial truths, but they often ignore something extremely important. Cash is not only an investment asset. Cash is a strategic financial tool. In fact, many experienced investors, businesses, and institutions deliberately maintain large cash reserves even when they could theoretically invest everything. Why? Because cash provides something that many other financial assets cannot provide: flexibility, security, and the ability to act when opportunities appear. The real power of cash is rarely explained because most discussions about money focus on maximizing returns. But financial stability is not only about maximizing returns, it is about managing risk, uncertainty, and timing. Cash plays a crucial role in all three. So in this video, we are going to explore the real strategic value of cash, not as a replacement for investing, but as a tool that supports long-term financial stability and better decision-making. Let's begin with the first and most important idea. Cash is liquidity. The first reason cash matters is liquidity. Liquidity simply means how quickly an asset can be converted into usable money without losing value. Cash is the most liquid asset in the financial system. You do not need to sell anything. You do not need to wait for market hours. You do not need to accept price fluctuations. When an emergency appears, cash is immediately usable. This is why financial planners consistently recommend maintaining an emergency fund. Unexpected expenses are not rare events. They are predictable in the sense that they eventually happen to everyone. Medical expenses, car repairs, job interruptions, family emergencies. Without liquid savings, many people must rely on credit, and credit often comes with high interest costs. Having cash allows individuals to absorb shocks without creating new financial problems. Liquidity does not generate investment returns, but it prevents financial damage, and preventing damage is often just as important as generating growth. Cash reduces forced decisions. One of the most underestimated risks in finance is being forced to act at the wrong time. Imagine someone who invests all of their money in the stock market. If the market falls sharply and they suddenly need cash for an emergency, they may be forced to sell investments during a downturn. Selling assets during market stress can lock in losses. Cash reduces the risk of forced decisions. With a cash buffer, investors can allow long-term investments time to recover. History shows that markets often move in cycles. Short-term volatility is normal, but investors who are forced to sell during declines may never benefit from eventual recoveries. Cash creates patience. Patience protects long-term investments. Cash provides psychological stability. Financial decisions are not purely mathematical, they are psychological. Many people underestimate how emotions influence investing behavior. Fear and uncertainty often lead to poor timing decisions. Investors may sell when markets fall or chase trends when markets rise rapidly. Having a financial cushion in cash often reduces emotional pressure. When people know they can cover months of living expenses, they are less likely to panic during economic uncertainty. This emotional stability can lead to better long-term decisions. In this way, cash acts as a psychological buffer. It reduces stress and allows individuals to think more clearly during volatile periods. Cash creates opportunity. Another overlooked advantage of cash is opportunity. Financial opportunities often appear during periods of uncertainty. Market corrections, economic downturns, temporary asset mispricing. During these moments, investors with available liquidity can act quickly. Those without liquidity may only be able to watch from the sidelines. This principle is widely used in business strategy. Companies often maintain cash reserves specifically to take advantage of strategic opportunities, acquisitions, investments, expansion during economic downturns. Individuals can apply similar thinking on a smaller scale. Cash allows flexibility. Flexibility allows action. Cash and risk management. Risk management is a fundamental part of long-term financial planning. Many investment strategies assume stable income and predictable market behavior. Reality is rarely that stable. Unexpected changes in employment, health, or economic conditions can alter financial plans quickly. Cash reserves provide a layer of protection. They create time. Time to adjust plans, time to find new opportunities, time to recover from unexpected setbacks. Without that time buffer, individuals may be forced into short-term decisions that damage long-term goals. Cash and financial negotiation power. Another rarely discussed advantage of cash is negotiation power. In many situations, buyers with available cash have more flexibility. For example, purchasing assets, making business deals, negotiating purchases. Sellers sometimes prefer buyers who can complete transactions quickly without complex financing. Cash simplifies transactions. This does not mean debt is always bad, but liquidity can strengthen negotiation positions in certain situations. Cash versus inflation. A common criticism of holding cash is inflation. Inflation reduces purchasing power over time. This is true. Cash is generally not designed to outperform inflation over long periods. That is why long-term wealth building often requires investing in productive assets, businesses, real estate, financial markets, innovation. But those investments function best when supported by financial stability. Cash provides that foundation. It absorbs shocks, reduces stress, creates opportunity, and protects long-term decisions from short-term disruptions. The real power of cash is not in its return, it is in its flexibility. Cash gives you time, it gives you options, and it gives you the ability to respond to uncertainty without panic. In a world that often emphasizes maximizing returns, it's easy to overlook the quiet role that liquidity plays in financial stability. But many experienced investors understand this principle well. Cash may not be exciting, it may not generate headlines, but when uncertainty arrives, its value becomes very clear. And in finance, resilience is often more powerful than speed.